Common stock. Common stock represents the owner's or shareholder's investment in the business as a capital contribution. This account represents the shares that entitle the share owners to vote on the residual claim on the company's assets. The value of common stock is equal to the par value of the shares times the number of shares outstanding. Preferred stock. Preferred stock is quite similar to common stock. The preferred stock is a type of share that often has no voting rights, but is guaranteed a cumulative dividend. If the dividend is not paid in 1 year, then it will accumulate until paid off.
Contributed surplus represents any amount paid over the par value paid by investor for stocks purchases that have a par value. This account also holds different types of gains and losses resulting in the sale of shares or other complex financial instruments. Additional paid-in capital is another term for contributed surplus, the same as described above.
Retained earnings is the portion of net income that is not paid out as dividends to shareholders. It is instead retained for reinvesting in the business or to pay a future obligation. Other comprehensive income is excluded from net income on the income statement because it consists of income that has not been realized yet. For example, unrealized gains or losses on securities that have not yet been sold are reflected in other comprehensive income. Once the securities are sold, then the realized gain or loss is moved into net income on the income statement.
Treasury stock contra equity account. Treasury stock is a contra equity account. It represents the amount of common stock that the company has purchased back from investors. This is reflected in the books as a deduction from total equity.
Cash dividend. The cash dividend is by far the most common of the dividend types used. On the date of declaration, the board of directors resolves to pay a certain dividend amount in cash to those investors holding the company stock on a specific date. The date of record is the date on which dividends are assigned to the holders of the company stock. On the date of payment, the company issues dividend payments.
Stock dividend. A stock dividend is the issuance by a company of its common stock to its common shareholders without any consideration. If the company issues less than 25% of the total number of previously outstanding shares, then treat the transaction as a stock dividend. If the transaction is for a greater proportion of the previously outstanding shares, then treat the transaction as a stock split. To record a stock dividend, transfer from retained earnings to the capital stock and additional paid-in capital accounts an amount equal to the fair value of the additional shares issued. The fair value of the additional shares issued is based on their fair market value when the dividend is declared.
Property dividend. A company may issue a non-monetary dividend to investors. Rather than making a cash or stock payment, record this distribution at the fair market value of the assets distributed, since the fair market value is likely to vary somewhat from the book value of the assets. The company will likely record the variance as a gain or loss. This accounting rule can sometimes lead a business to deliberately issue property dividends in order to alter their taxable and/or reported income.
Scrip dividend. A company may not have sufficient funds to issue dividends in the near future. So, instead it issues a scrip dividend, which is essentially a promissory note, which may not or may include interest to pay shareholders at a later date. This dividend creates a note payable.
Dividend. When the board of directors wishes to return the capital originally contributed by shareholders as a dividend, it is called a liquidating dividend and may be a precursor to shutting down the business. The accounting for a liquidating dividend is similar to the entries for a cash dividend, except that the funds are considered to come from the additional paid-in capital account.